The Complete Turtle Trader by Michael Covel.
The true story of how 23 novice investors became overnight millionaires. Market wizard Richard Dennis, the trend-following pioneer, discloses his mid-1980s turtle trading experiment, where his group of novice traders strictly followed his rules, and over a 4-year period, made $150 million. We take a glimpse at the story, the stats, and learn what we can from the trading system. Richard Dennis started from humble beginnings in the early 1970s, starting as a runner on a trading floor at the age of 17, and a few years later, he traded his own account. He originally borrowed $1,600 and spent $1,200 on a seat at the Mid-America Commodity Exchange. He soon turned the remaining $400.
Hey, there's PJT, Paul Tudor Jones, one of the greatest traders ever. That's not a picture of Richard Dennis. I don't know if that's going to play into this.
Into $3,000 in a short space of time. And between 1970 to 1973, he turned his equity into $100,000. A year later, he returned a profit of $500,000 trading soybeans, and by 1975, he was a millionaire at the age of 26. Dennis later formed a partnership with fellow trader William Ehart, a PhD mathematician who also successfully applied his knowledge to the stock market. Both Dennis and Ehart fell into a philosophical disagreement. Dennis believed that his trading system could be taught to anyone providing there were a set of rules, whereas Ehart disagreed. The argument became a catalyst towards the creation of the...
Okay, we're going to go back slightly. So William Ehart believed trading was intuitive. Trading was something you were born with. Trading was something you just felt. You can feel the market, right? You can tell when directions are going to change. Where Richard Dennis is like, what? Hold my beer. Richard Dennis was like, bro, what are you talking about? Anybody can learn to trade, right? It's just trends. Just follow along with the trends. You'll never catch the top. You'll never catch the bottom, but you can catch the 80% in the middle and you can make buttloads of money. I am in the Richard Dennis camp. Clearly, because we're doing this, right? I think taking this stance of trading can't be taught, you're either born with it or not, is so elitist, it's so asinine, and so stupid. Give me a freaking break. That reminds me of when, what year was this? Probably 2016. I met with a CNBC contributor. His name is Michael Coe, Michaelkhou. I met with Michael Coe in Austin, and had a conversation with him. And my conversation was, hey, Michael, do you think that I should start a podcast? Because I love trading stocks. I think that I could do a great job on TV just like you. And he said to me, you know what? Nobody's gonna listen to your podcast. Nobody cares. Just don't waste your time doing this. And I was driving home and I was like, screw that guy. He just doesn't want somebody else stealing his thunder. He doesn't want people talking about the same thing he talks about because that's more competition for him. So screw you, guy. Screw you so hard. I did learn rolling options from him, but screw you so hard. And William Ehart, screw you so hard. You're so wrong.
Turtle trading program. The name was inspired by a previous trip to Singapore, to which Dennis said, "We are going to grow traders just like they grow turtles in Singapore." Soon after, their firm C&D Commodities placed this advert into the Wall Street Journal, Barron's, and the International Herald. The point of experience not being necessary is the key takeaway from the advert. We will learn shortly that the group were far from experienced traders. In total, there were more than 1,000 applications to take part in the experiment. The experiment would provide 2 weeks training, and each would be provided with a $1 million account to trade with. The successful applicants had varying backgrounds.
Just think about that, right? Imagine you had the opportunity to take a job where you got 2 weeks of training and then they gave you $1 million to trade with. That is so crazy. This isn't paper trading. This is real money trading, right? This is back in the early 80s, I think, where like it was impossible to do what we do today using charts and things. And that's so crazy to me. So crazy. But that's how much he believed in his system, right? In fact, Richard Dennis has this quote. I always say you could publish the rules in a newspaper and nobody would follow them. The key is consistency and discipline. That's what he tried to instill into these people. You need to have consistency and discipline.
Including a blackjack player, a computer game designer, a pianist, and an Air Force pilot. The group went on to earn over $150 million, which suggested that Dennis's theory was right. You could teach anyone to trade.
Suggested? I feel like getting a 150x return on your money definitely suggested that it works.
Provided they were given the appropriate training. Or put another way, trading is learnable and not an inborn talent. In January 1984, during the 2 weeks of training, Dennis and Ehart focused on teaching the foundation of their trading style. The theory and concept of their style was hugely important. It was never about numbers moving up and down on a screen. There had to be a theory behind the method. Dennis went on to say, you need the conceptual apparatus to be the first thing you start with, and the last thing you look at. The turtles were taught to think of themselves as scientists first and traders second. The trading outcome was simply a result of the laws of reasoning. This thinking put Dennis ahead of his time, and years later, the academic Daniel...
I want to tag on to that. What does that mean? That goes back to my slide. Where is that? Here. There's no expectations on the trade, right? There's no profit targets. You just get out when one of your profit targets or when your exit signals is hit, right? Because you can't tell the market how much you're going to make. You cannot walk up to the market, go boop, boop, boop. This is my ATM. Boop, boop, boop. I need $200 today. Boop, boop, boop. Here's your money. It doesn't work like that. I mean, sometimes you make $200. Sometimes you make $20,000. Sometimes you lose money. You can't tell it what it's going to do. And I think that's what he's trying to say in that law of reasoning right there.
Daniel cover themselves as scientists first and traders second. The trading outcome was simply a result of the laws of reasoning. This thinking put Dennis ahead of his time, and years later, the academic Daniel Kahneman, author of Thinking Fast and Slow, won the Nobel Prize for prospect theory, also known as behavioral finance, which encapsulated Dennis's prior teaching. Fortunately, after a 10-year contractual secrecy pact ended in 1993, we have been able to gain access to the rules of the system. Let's take a look.
By the way, some of what I trade, you're going to see exactly where it came from here in just a moment.
Although we disclose the rules here, it's important to point out that a successful system is more than just a set of rules. Dennis says, I always say that you could publish my trading rules in the newspaper, and no one would follow them. The key is consistency and discipline.
I've never heard that before.
Almost anybody can make up a list of rules that are 80% as good as what we taught our people. What they won't do is give them the confidence to stick to those rules even when things are going bad. With these rules, confidence and discipline, embedded over just 2 weeks of training, the turtles earned an average annual compound rate of return of 80%. The turtle trading system had...
Dude, I don't know if you understand. Average compounded annual growth rate of 80% is absolutely bonkers. Unbelievably bonkers. That means on average, that means some people outperform this and some people underperform this. On average, 80% in your account every single year. Bro, that's nuts.
Had no room for subjective decision making. It was considerably mechanical, promoted consistency, and eliminated any form of subjectivity. We evaluate the turtle system against the following components. The turtles traded commodities, more popularly known today as futures, but the most important criteria when considering the future contract was the liquidity of the underlying market. Due to the amount of money being placed...
How often do I talk about liquidity? How often do I talk about liquidity? If you can't get in, you can't get out. And if you can't get out, you're stuck. That's so important.
Into the market by the turtles, anything with a low trading volume would have made entering and exiting positions extremely difficult. This leads us on to position sizing. Turtle trader Curtis Faith said, position sizing is one of the most important but least understood components of any trading system.
Okay, before he talks about position sizing, I'm going to show you my formula for position sizing, and we can compare the two. So, for me, this is what I learned. Take your account balance and you multiply it by how much risk you're willing to take. Risk meaning how much you're risking in your account, not position, not portfolio size, but risk to your account. So, for example, if you put on a $100,000 trade, you're okay with losing $5,000. That sucks, but that's the risk you're willing to take. Now, you can actually go significantly larger in your portfolio size. You may be even going to do 50,000, 70,000, because you're not risking the entire thing. You're only risking a portion of it. And then dividing that by 2 times the ATR gets you your shares. And then for me, because I trade deep in the money options, I would divide that by 80 delta to get approximate number of option contracts. So that's my formula. Let's see where they go with this.
The turtles were taught a concept called N to represent underlying volatility of a particular market. And once N had been determined,
N is ATR, by the way.
The position size could be calculated. Therefore, although the position size was a fixed percentage, it was also volatility-based. The
Position size is volatility-based. Sounds pretty familiar.
calculation of N is simply a 20-day moving average of the true range, commonly known today as the ATR, or
Now, my ATR, I just use the default 14. Maybe I could change it to something else, but I just use the default. And theirs, they're using the 20-day average of the ATR.
average true range. The turtles used a position size calculation based on 1N equaling 1%. Therefore, if N was determined to be 2 for a particular market, then the position size would be 2% of account equity. The turtles called their position sizes units, and the formula is seen here. The maximum amount of units that could be traded on a single market was 4.
So, while not exactly the same, because I actually did get this formula from Larry Hite, one of the first, he was the first billion-dollar hedge fund manager, one of the original market wizards. I actually got this formula from him. But similar concept, right? You're basing your position on the volatility of the stock itself. So if the stock's super volatile, because that's the denominator of the factor of the formula here. I love math. I can get so nerdy. And most of the time, you guys have no idea because we haven't traded in ages. So you don't see my nerdiness. Because that's the denominator of the formula here. It actually shrinks your position size in shares whenever the ATR is huge, right? Whenever the ATR grows, your share size, the output shrinks of the formula here.
The strategy also included the adjusting of account size. Therefore, if the markets were not moving as hoped, the notional account size would be adjusted to suit. For example, if the account size was originally $1 million, but the account lost $100,000, equaling a 10% loss, the turtles would base their next trading position on an account size of $800,000, or a 20% loss. So for every 10% drawdown, the turtles would trade based on a theoretical 20% drawdown. This would help protect capital, should the markets continue to trend abnormally.
So basically, if they are in a drawdown, they trade even smaller and smaller until they get back to at least whatever their break-even point is. And that's such a smart risk mitigation tool, right? Because rather than trying to dig yourself out of the hole, you're saying, let's say if I had 100 shares and I'm losing money, okay, I'm only trading 80 contracts now, or 80 shares. Okay, if you continue to lose, okay, I'm only trading 60 contracts now. Because number one, it's going to help you build up your confidence back without feeling all that risk and all that pressure. But a lot of people don't do that. A lot of people, including Tom Nash, will say, hey, if it's going down, that's when you start doubling up. That's when you start going twice your normal position size. That way you can catch up faster. Can you? Sure. Or you could be digging your hole twice as fast. You choose.
The next component of the turtle system is the entry. And contrary to popular belief, the entry criteria for the turtle system is far from complex. It was based on the channel breakout systems taught by the notorious Richard Donkian, commonly known as the Donkian's channel breakout system. There were two systems to choose from.
I wonder if he was a monkey Donkian. I've always heard his name is Donchian, not Donkian. Donkian around here. But to talk about this before he gets into it, you can actually add Donkian indicators. So you can go Donchian channels. Dadgummit. There it is. Donchian channels. So basically anything. In fact, it looks like I had previously had this example. So in this example, if it breaks out of a certain range, be it 20 days, 50 days, whatever, and goes to a new high. So this was the high point over the last X number of days. And you see right here, it went out to a new high. That would have been an entry signal for them. And then again, another entry signal right there. Is this the best signals in the world? I don't think it is. But that is how it works, right? When it breaks up to a new high, that would be the entry. So let's see how he explains it.
A shorter-term system based on a 20-day breakout, or a longer-term system based on a 55-day breakout. Some traders chose one system, whilst others chose a combination of both. An interesting point to make is that the turtles did not wait for the close of the day to determine if the price remained above the breakout point. They would enter the trade as soon as the price broke the time frame being measured. They would trade in either direction by buying the high or selling, going short, on the low. The turtles were told to pyramid the trades thereafter. For example, for every 0.5% change in price after breakout, the traders would add another 0.5% of their account to the position, up to a maximum 2%.
So talked about this earlier. That is something I used to do, but what I found is that when I would lever in like this, and then let's say it turned around, rather than having my original position size working against me, I now would have 2 or 3 times as much coming right back at me than I did going out. And that sucked. So that's why, for me personally, I only go in at my full position size all at once. And if it works, awesome. I got my full position size from the go. If it doesn't work, I'm out fast.
The turtles were told to be very consistent with the entry rules, knowing that most of the returns come from a minority of trades. So if one trade was missed, it could have a huge impact on profits. An expression commonly used is, there are old traders and there are bold traders, but there are no old bold traders. Traders that don't have stops go broke. The turtles had a predefined risk on every trade. This was non-negotiable. The maximum exposure to any position was 2% of total equity, or 2N, when accounting for volatility. Additionally, any pyramided positions would also have the stops raised, therefore ensuring maximum exposure always remained at 2%. Due to the size of funds traded, however, the turtles did not enter the stop-loss position with a broker. They did not want to reveal the positions to the market.
And that's what I do too. I do not put my stop losses in the market at all whatsoever. Not to hide my trade or anything like that, because how many times have you seen a candle? Let me turn this off. That's ugly. How many times have you seen candles wick past your stop, take you out, and it's like, oh, bro, this sucks, right? That should have never happened, right? How many times have you seen a move like this and then a move like this, right? And if you had set it at that 10 EMA, you would have been stopped out right there. Or maybe something like this, right? It was close, but it may not have closed right on the other side. So yeah, I don't put my stops in the market, not to hide my trades, but because there will be different moves all during the day. I only care about the end of the day prices.
Instead, the stop-loss figure, although predefined, was not entered until price reached the price set. Since the stops were based on N, i.e. adjusted for volatility, volatile markets had wider stops and less risk per contract. This reduced risk across all positions and gave improved risk management. Another old saying suggests, you can never go broke taking a profit. But knowing that the turtles were trend followers, this would have often meant taking profits too early, which is one of the most common mistakes when using trend following systems. Take this trend as an example. Many traders would have perhaps taken their profits here after a spike in price, or possibly here after a pullback. The temptation for either exit is often too great. Of course, every trading system is different, and exiting at these points could make sense for the concept of your system, but for the turtles trend following system, this would have led to poor performance. So how did they exit a profitable position? Again, the exiting rules were not complex, but allowed for the capturing of a full trend. System 1 exit was simply a 10-day low. Therefore, if a 10-day low was experienced at any point in the trend, the position would be exited.
You could think of that like your 10-period EMA. How about that? When your 10-period EMA is broken, now might be the time to exit. And I've shown red light, green light hundreds and hundreds of times on YouTube's here. And it's because it works, right? It tells you when something's not acting right. Does it mean it's going to be a perfect exit? No. But it's called red light for a reason, right? Like, for example, this pullback right here, this 8% pullback right here. It didn't break under the 10 EMA until this very candle. Red light. And then, because it can't break through here unless it goes through your 10 EMA first. So that is a warning sign to me. Anytime your red light's broken, get out of the way.
Likewise, System 2 had a 20-day low exit. In terms of complexity, they were simple.
And then same, your 20-period moving average. It can't crash until it goes through your 10, and it can't crash until it goes through your 20. Just mathematically impossible.
Rules, but in terms of the psychology and discipline, following such rules is very difficult. At times, these 10 and 20-day rules would see large profits evaporate in a comparatively short space of time, especially if the chart looked more like this. Dennis said, a good trend-following system will keep you in the market until there is evidence that the trend has changed. These exit rules provided the evidence, and the turtles would exit without hesitation. Before we move on to some of the results produced, this comment from Dennis summarizes his thoughts. Trading was more teachable than I ever imagined. Even though I was the only one who thought it was teachable beyond my wildest dreams. In 1989, the Wall Street Journal produced an article showing the results of 14 turtle traders taught by Dennis and Ehart. Here we have the range of annual results for each trader, and here the average annual returns for 4 years of trading. Notice how Stig Ostgaard achieved a staggering range of between 87% and 296% per year. The average return of all turtle traders equated to 80%, whereas the Barclays CTA index, which reports the results of 110 advisors holding more than 4 years' experience, achieved an average of 25%. The S&P 500 returned 19.2% in comparison. Each of the turtles would keep 15% of the profits, whereas Dennis and Ehart would keep 85%. Clearly, the teachings from Dennis and Ehart provided huge performance benefits, with each of the turtles achieving considerably more than popular benchmarks. In summary, it was proven that in such a short period of time, someone with no prior experience could be turned into a professional trader. The turtles understood the concept of a simple trend-following system, and by applying good risk management, sticking to the rules with unquestionable consistency and discipline, outstanding results could be achieved. A great story for inspiration, achieving 5 stars. Thanks for listening. Please hit the like button.
Dude, I'm telling you, this is one of my top 5 favorite trading books, and he didn't even cover 90% of it. There's so much good stuff in here. Now, I only have a handful of flags in this because it's more of a storybook than it is a textbook, which means it's fantastic on Audible. But a couple of my flags that I wanted to share with you real quick. So page 83. Talking about ins. So we talked about ins on there. How to find your position sizing using the in. Then page 87, adding to winners, which like I say, I used to do that. I don't. But it does say specifically on page 87, they set their stops at a half in on the first day. Now they actually move their stops, which is crazy to me. But they would set their stops at 1/2 in. So 1/2 ATR. I didn't come up with that. The turtle traders did. I didn't come up with that half ATR. The turtle traders did. Pretty cool, right? And then page 104, the turtles would come in every day already armed with their war plans, so they didn't make any bad decisions in the heat of battle. They wouldn't stare at the screen and say, do something, trade me. All the top traders today work like hell to develop a trading philosophy. They convert their philosophy into rules, and after that, they stand back and see if their rules act as expected, aka backtesting. If you build a system that gives you entries and exits, tells you how much to bet along the way, and adjust to your capital and current market volatility, no more analysis is needed. I am giving you everything you can possibly have to be successful. But you got to stop with this FOMO crap, all right? You got to stop looking at the market on a day where it's up and be like, "Oh my gosh, why didn't I buy it?" Nah. You can't do that. I am handing to you, in my opinion, the very best trading philosophy, the very best trading strategy, the very best thing that you could possibly have in the market. Will it win every time? No. Does it work all the time? No. But when it does work, trading is effortless. And in the meantime, sit in cash and don't F up. Sit in cash and don't F up. Christopher says, man, I had a buy stop, tanked on the morning trade. I learned. It's okay. Yeah, this isn't a casino. This isn't a casino. Exactly. Mara says, I got to stop. Yeah. Now, you will be able to stop really soon because in Outlier, we have the master key here that shows you if it's unlocked for the bullish or unlocked for the bearish. But right now, it's locked up in both directions, which means the trade is cash right now. The trade is cash right now. So take the time right now where you're not doing anything and go over to OUTLIERdeal.com. And over at OUTLIERdeal.com, you can sign up and have a chance to win $1,000 and a free year of Outlier. And the first runner-up gets $200 worth of merch and my 5 trading book bundle, including the complete TurtleTrader. Second runner-up gets $150 worth of merch and my 5 favorite trading book bundle. And if you can believe this, we already have over 10,000 entries in this. Over 10,000 entries. And Deep Thought is winning bigly at 317 points. Now, it's still a raffle at the end of the day, so you can still win. Deep Thought has hacked us, and he told me how he hacked us. And you need to hack us as well. Apparently, if you refer people to do this, where's this at? if you refer people, where was that at? Is it a page? I don't know. Somewhere he figured out that if you refer people, you can get more posts all the time. And so he's referring a buttload of people. So you can do the same. You can do the same. And some of these you can do more than once. You can do it every single day. So I really encourage you to head on over to OutlierDeal.com so you can be entered to win $1,000 and a free year of Outlier. And I'm telling you, we are trying to make this, at the top of the clipboard. The top of the clipboard. Where's the clipboard? There's a clipboard? I have to log in first. Okay. I'm not eligible. I'm not eligible, so I haven't logged in. Thank you for that. Look at that. You taught me something there, skinny buff guy. Have no mo FOMO. Have no mo FOMO. But we will be having trading cohorts just like the Turtle Traders did. We're going to be having exactly the same cohorts just like the Turtle Traders did. And I cannot wait to teach you everything that I know. This is going to be awesome. We're going to change the world. And you're going to be along for the ride with it, right? And I challenge anybody who was that. I saw this comment. Somebody saying that all people on YouTube are scammers. You know what? I challenge that person to follow along and see just how much money they win. And if that happens to be the case, then by God, I guess I'm the world's worst scammer. So thank you so much for coming to this special live stream. Don't forget, if you're ready to save time, make money, and start winning with less risk, I'll see you Friday morning. I won't be here tomorrow, but I do want you to click one of these videos that YouTube's popping up right now and have a fantastic afternoon.